Hey, this is Sasha Evdokov, and thanks for joining me here for another stock trading and investing video. Now today what I'd like to do is go in detail about showing you what does it mean on buying a call option and how you can execute that trade in order. So if you're new to option trading, if you're just getting started, this is a good video to watch. There's a handful of other videos that I have regarding the basics of option trading. By all means, take a look on my website at tradersfly.com. where you can see all those videos in the options section. Now, with that being said, let's take a look at buying a call option and ultimately what that means for you personally and how you can capitalize and make some money from it. So first off, you might be wondering, what is a call option? Okay, you might have heard about option contracts in the past, but there's calls and puts. That's ultimately the basic premise behind option contracts. And if you're looking at a call option, you need to understand what is a call option. Basically, when you're buying a call, it means you're looking for the stock to go to the upside, bullish. Okay, you're looking for a bullish bet or a bullish direction. Now you can also sell a call, which means you're looking for the stock to go down or it's a bearish position. So keep that in mind. You don't need to own inventory or anything like that in order to sell calls. You don't need to own stock to sell a call or buy a call. There's four parts to those trades. You can buy a call, you can sell a call, you can buy a put, you can sell a put. In this case and in this situation, we're talking about buying a call and how to do that and what does it all mean. So for people that are looking to buy a call, they're typically looking for a stock to go up and they have a bullish outlook. Now, that's not always the best scenario and situation to trade options, but this is just a starting point to understanding how options work. Now, if you need a little bit of a cheat sheet, here's my cheat sheet for looking at these different directions. So if you're a buyer and you're looking for a call, you typically want stock prices to go up. If you're a buyer of a put, you want stock prices to go down. If you're a seller of a call, you kind of are in the similar situation of buying a put because you want stock prices to go down. And if you're a seller of a put, you want stock prices to actually go to the upside because you're taking the opposite side of the trade. So if you really look in this diagram, right? So if you're a buyer of a call right here, if you're taking the other side of the trade, well, it would be kind of a seller of a put. Right? And if you're looking at it in the other perspective, right? If you're a put and typically you're buying a put and you want prices to go down, in the other scenario, if you're a seller, okay, if you're a seller of that call, it's basically the same thing, right? So anyways, that's how they line up and look together. So if that helps you out, by all means, use it. Let's take a look at the risk profile picture of buying a call. If you're not familiar with risk profile pictures, it just shows you where your profit and loss ultimately is. So in our case and scenario here, this on the left side is our profit, and then we have our loss based on the zero line right there. So anything above that zero line is a profit, anything below is pretty much a loss. Now, the stock price is here towards the bottom axis, okay? So if the stock price is, we start out at $35, okay, so if that's our starting point, that's the zero line, and the stock price actually goes up to 40, okay, we would be at this price point, which means we draw it across, that's our profit point. Okay, if we go into the $50 range, okay, that's our profit point. It's a little bit higher. So what is the pink line and what is the dark black line? Well, the black line is at expiration, right? That's at the end when that contract expires. The pink line is today. So if that price went today to the upside, I would make the most or the maximum amount. However, the problem is that with time, that line gets closer and closer to that black line. The pink line gets closer and closer to the black line. So you actually are playing against time when you're dealing with buying a call position. And that's really the difficult part for many traders. And that's why they lose a lot when it comes to options, because they buy a call. If the price goes down a little bit, plus they lose some of the time value and it gets to 30 here, they're at a loss, not only from the price perspective, but also from the time value perspective. So anyways, that's how this profit picture works. It's really easy to understand these and look at them once you get the hang of looking at profit picture. Simple terms, anything above that zero line, if you fall into this range at, let's say, this price point you're at a profit. And if you're kind of below that range, you're at a loss, because that is your zero line. And right here on this black line, that's your maximum risk. So that's your maximum loss as well. Now, on buying a call, you have unlimited profit potential, right? Because you're looking for an upside move. You have unlimited profit potential in this example and in this scenario and situation. So that's a lot of times why people buy a call contract. However, it's not always the most profitable, simply because you need that stock to move. When we show you some examples here with looking at selling a call versus buying a call, in this case, if the price is right here, if it stands still, you lose money. If it goes down, you lose money. The only time you make money is if it goes up and in your favor quite a bit. And that's kind of one of the tough things about buying call contracts. So let's look at how to buy a call option contract on a trading panel and platform. So here I am using the Thinkorswim platform. Now, you could do this in any other brokerage platform if you want. This is just paper money or fake money. And you could go to any stock that trades options. Let's just say I wanted to trade Nike as an example, and I wanted to purchase a call contract here at $55 a share. Now, the typical way or the traditional mentality is that what I can do is go ahead and buy a single. And because I'm choosing the 55 strike price, where it also gives me 59 days, if I analyze this, you'll notice the profit picture right here on Nike. As I spread it out, it'll start to look like the drawing or the diagram that I showed you earlier. Okay, so removing a few of these slices right there so you could see kind of the live price. Here is where we are. Let's see here, make sure the date is today. And there we go. So you can see, looking at this, okay, at the bottom is Nike's strike price. Okay, those are all the prices. The current price is right here, 51.54, okay, 51.56. I'm looking at 55 as my strike price. So I need it to get here and higher to cover that bid-ask spread a little bit. And that's that tick mark right there. Now, the basic way that most people do this is, well, I'm targeting 55. If it gets to 55 or above in that 60-day time frame, I can buy the stock. Even if it's at 56, I can buy the stock at 55. That's what it allows me to do. That's the traditional way. Now, most people who are option traders, they simply do just the trading within options, because what happens is as this gets into the $55 range, you're actually at a profit, and in this case, about $120. Now, that's if it happens tomorrow. With time, that white line right there will get closer to the green line, and it may only be, $90. But in general, you could just simply get out of the contract and collect your money. So that's another option. So you can see right here, if it goes to 55, I would collect $126 right there. Now, if this happens within a few days, right, watch what happens as I move the time. That white line continues to get closer and closer to the green line. Okay, so if it happens 55 within a few weeks, I'm only making $76, right? So I basically need this stock to move, and that is because of that theta, or time decay, time value. Now, the most that I can lose is right here at this green line at the bottom right there. It is $64, which is what I buy or pay for in the stock. It's 64 cents. Multiply that times 100, because each option contract controls 100 shares of stock, which gives me that $64. That's my max loss. Okay, so ultimately, that's what it looks like when you're looking to buy a call option contract. And the way that you would execute it is I could just right-click, confirm and send, and you can see right there, it would actually cost me about $71.70 with commission, and I can go ahead and send that in if that's what I wanted to do. But in this case and in this situation, I'm not going to go ahead and do that. It's simply a paper trading account, and we are not in a live market anyways. but that gives you an idea of what the profit picture looks like, what a call contract does, and how to use it. Now, of course, you could shift it a little bit closer if I wanted to do, let's say, 52.5. Now it gives me a little bit of a tighter range and also a little bit more profit potential, right? But it does cost me a little bit more. So here I'm risking $146, right? Because I'm tighter and closer because the chance of success is higher. Rather than if I go to 55, I'm only risking $64. Okay, so there's a big difference there. As the tighter you go, 52.5, you can see right there, it's worth more, but it also allows me to make more, because if this goes to 55, okay, if this goes to 55, I'm making 196. If I do the 55s and it goes to 55, okay, I'm making 128. Okay, if I do the 60, let's say the 60, and it goes to 55, okay, you can see I only make $33. That is because that slope of that line and that curvature, the further out you go, the smaller this delta is, which is basically the move or the dollars you make for every $1 move in the stock. So at 60, you're only making $4 for every $1 move. At, let's say, 57.5, you're making 11. At 55, you're making 24. At 52.5, you make 43. You'll probably even go into 50, you make 64. Okay, so that's already in the money when you're looking at it, but it still gives you a higher move, because once it hits 55 here, you're making about $252. Now again, you're risking much more, $2.85, which is $285 if you look at your profit and loss picture, but you're able to also make more. So anyways, that's kind of the basics behind a call option and buying one. And to execute it, right click, confirm and send. If you're doing a different trading platform, there might be a go button or submit button, but that's the baseline behind it. All right, so thanks for joining me in today's video. Hope you got some insight about trading options and about the call contract. Now, if you want to see some of the in-depth video training lessons that I have, including some of the option courses where we go in 10 hours and 20 hours in detail about option trading strategies, then go and visit my website at tradersfly.com. Now, if you want to join me in a live webinar class or ask me some questions on a Q&A session, get on my newsletter list by clicking the button right here. When you get there, enter your name and email address, and that's where I send out the announcements for those live classes and live sessions. Thanks again, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.